Many dividend investors love the Schwab US Dividend Equity ETF, ticker symbol SCHD. You see a lot of videos about it on YouTube. You see a lot of articles about it on websites like Seeking Alpha. You see that the fund itself has a very large and substantial assets under management, and there's good reason for that popularity. It offers a higher yield than the S&P 500 by nearly a factor of 3. It has very solid dividend growth that's significantly beaten the S&P 500 over time, and it has a very low expense ratio that's comparable to most S&P 500 ETFs. And so, that's great. It's like the quintessential dividend growth investing dream ETF. But here's the problem. SCHD's growth is slowing, and it's packed with slower growing blue chips like Coca-Cola and Pfizer, which are great companies, but they're just not growing at nearly the pace they used to, and they don't really pay out that great of a yield either, at least in some cases like Coca-Cola. And this means that it does not maximize your income growth, or ultimately your total return potential as much as if you were to take a different approach. And so that's why I don't invest in SCHD. Instead, I handpick individual dividend stocks that offer higher starting yields, faster dividend growth, greater long-term total return potential. And today I'm going to share 2 big dividend growth stocks that are outperforming SCHD on every major metric, whether it be dividend yield or dividend growth, while still being very blue chip investments. And so if you love dividend investing and building passive income, please watch this video to the very end. And if you appreciate deep dive dividend analysis, make sure to smash that like button so it can get this video in front of a larger audience, and subscribe to my channel to not miss my future dividend investing videos. Thank you very much. So why is SCHD good, but perhaps not the best for dividend growth? Well, it's been a great fund, as I've mentioned before. It has a higher yield than the S&P 500. It has a stronger growth rate than the S&P 500, for example. Over the past 10 years, SCHD has grown its dividend at an 11% CAGR, whereas the S&P 500 has only grown its dividend at a 6.3 CAGR over that period of time. But there's still a problem. SCHD's dividend growth is decelerating. Over its 10-year rate, it's at 11%. Over the past 5 years, it's a little bit under 10%. And over the past 3 years, it's also been below 10% CAGR. And so why is it slowing? Well, its top holdings, again, like Verizon, for example, Coca-Cola, they aren't growing their dividends at a rapid pace anymore like they used to. And if you want higher dividend growth and higher total returns, you can't just buy SCHD and hope that it's going to keep doing what it's done forever. You need to actually handpick your individual stocks. And these are the 2 that I would pick if I wanted to do that. First of all, Blue Owl Capital. I've talked about this in some of my other videos, but it's an alternative asset manager that's been crushing the competition since going public. Its current dividend yield is about a 4.6 to 4.7% as of this video's making, and it's expected to grow its dividend at a mid-teens CAGR through 2029 based on analyst consensus estimates. In fact, management might even argue that it'll be faster than that, which convincingly beats SCHD. So its dividend yield is about 100 basis points higher than SCHD's is, and its projected dividend growth rate is several hundred basis points faster than SCHD's is. On top of that, its earnings per share growth rate is expected to be even higher. In fact, management's arguing for 20% plus CAGR over the next 5 years. Analysts are saying maybe 17, 18% CAGR, still very impressive. And so this makes Owl, again, a phenomenal dividend growth stock. And on top of that, it's pretty conservative. Over 90% of its fees come from permanent capital, which makes its earnings stream much less volatile, especially given that all of its income comes from FRE, fee-related earnings, as opposed to carried interest that some of its peers like Blackstone have. It also has an investment-grade balance sheet with no major debt maturities until 2031. So again, it's a fairly low-risk blue chip that you're not going far out onto the risk spectrum, but meanwhile you're getting a higher yield and faster growth than you would with SCHD. What's the second high yield, high growth stock that I like a lot right now? Well, MPLX is one. Again, this one has a very high yield, a yield of well over 7%. That puts it in a clear class above SCHD. In fact, that means its yield is about twice what SCHD's is. On top of that, it's expected to grow its distribution at a roughly 10% CAGR through 2029. It's been growing its distribution recently at a 12.5% rate. Analysts think it can do close to that over time. Management's guided for a 12.5%-ish hike pace for several years to come. And after that, it'll probably slow a little bit heading into 2029, which is where we get the 10% CAGR. And so again, with that, you get a growth rate that should comfortably beat SCHD's, a yield that is way faster than SCHD's. Again, you get a solid investment grade credit rating, BBB, for MPLX with low leverage of about 3.1 times at the moment. Very stable, long duration cash flows from the contracted midstream infrastructure assets that it offers. It's also buying back units opportunistically, investing in new growth opportunities. And so again, with MPLX, you're not going out on the risk spectrum and you're still getting that high yield and high growth. So again, I'm not saying don't own SCHD. I'm not saying sell SCHD. I'm not saying SCHD is a bad fund. As far as diversified dividend ETFs go, it's hard to think of one that I would like more than SCHD. What I am saying is you can do better. And even if you want to hold SCHD in your portfolio, again, I don't hold that against you at all. But if you want to diversify further and complement it with some other holdings, I think OWL, MPLX, and several others are good complements to SCHD that can boost your yield, boost your growth rate, and further diversify the portfolio, thereby actually reducing your risk at the same time. It's kind of a no-brainer move to do that. Or, again, if you want to be like me and really roll up your sleeves and fully actively manage your portfolio, skip SCHD altogether, forget about it, let other people chase after it, and instead pick individual stocks that yield higher dividend yields and give you faster dividend growth moving forward. So let me know in the comments below. Would you rather invest in SCHD and forget about it, or would you like picking your own individual dividend stocks to try to get a better yield and or better growth rate than SCHD? Let me know in the comments below. And again, if you liked the video, smash that like button, help me reach a larger audience, and subscribe to my channel to get more of my insights in future videos. Thank you very much. See you next time.